Hello and welcome to our webinar. We're going to start getting people loaded in here. So in the meantime, publish a little poll here. So if you look off to the side, you should see a poll. It'd be great to get some feedback here because this is one of those things that I always have to bug people about constantly. And the funniest one probably I have is I have a client that since 1998, because I had looked it up one point, he's been telling me he's going to get his will done. His son's now in his 30s. He doesn't have to worry about guardianship anymore. So a lot of things have changed since then. So he still has not yet got it done. So yeah, that's one of those tough things about the things we should do versus the things we want to do. So that's what a lot of tonight we'll be talking about is, what should we be doing? So again, while we're getting everybody online here, please take that poll, answer that. It'd be great. Also online here, just so you know, is my one of the people from my team, Janine. If you have any questions, anything comes up, any issues, just let her know. There's a chat feature too, and so in that chat feature, you can ask her any questions or something, and I'll also try to answer any questions. So one of the biggest things, of course, when you're talking about webinar stuff, is it's harder to get a little bit instant feedback. So if you do have questions come up, let me know. But letting everybody kind of log in, it always takes a little bit longer than you think here, but I think we got a lot of the people, looks like, there. And thanks a lot for the people who are answering that poll there. Let's see. So, wow, yeah, that's pretty much about the stats. I like the people who answered maybe to do you have a will or a trust. If it's a maybe, then you probably can't find it, which means I bet nobody else could if something happened to you. So again, that's why we're talking about this tonight and just kind of going over, what things should you be doing? What should you be doing with your estate planning? And how does that affect your whole financial situation? So just kind of go through here. You have to have a disclaimer. I'm not an attorney. I'm a financial advisor, registered investment advisor, which means you have a fiduciary duty to do what's in your best interest. This is one of those big sections that I think people really ignore. And recently we've had some clients pass away, and fortunately we've had some that did not ever get their act together in terms of estate planning, and left a lot of mess and a lot of headaches for their loved ones, which is not usually what you want to be leaving behind, right? So again, that's what we're here tonight to kind of go over and see, okay, what should you be doing? So let's see. Well, I think we got most of the people done with the poll there. So the other thing too is if you do want to set up a time to call or talk, just let us know. And there's a button over the side, or we can just talk about this, find out what's the kind of issues, what concerns you have. But a couple of things that we're going to cover tonight really is what's the difference between a will and a trust. How can LTC, which is long-term care planning, affect my estate? How can I ensure that I retire successfully and really transfer those assets to the next generation with the least amount of tax and the most amount of control, where they hopefully spend it rightly versus wrongly. I've got 3 boys, and I hope they would do the right thing, but you never necessarily know, right? So, what are some foundations of protecting your estate? Well, a couple of the big things, of course, is a will. So, will basically is an instruction manual from you to the court system, to attorneys. Everything's public. You have to go through this process called probate, which is to prove. So what it's doing, it's proving who should get your stuff. Now, the problem with that is you're talking about that in front of everybody. And in today's world, that means anybody can see all your records. That could be scamming people. They can be doing all sorts of stuff. So, and they don't have to necessarily follow all your directives if it was poorly written or wasn't written nicely and so forth. So, really what we want to do is we want to make sure that if you have a living trust, what that does is I like to think of it more as a corporation. So if a corporation doesn't die, somebody changes over the CEO, somebody else now is running it, right? It stays around. And so really what we're talking about there is, if you have a trust, the trust owns those assets And what happens is when you pass away, if you're married, then your spouse is now the sole trustee, the sole beneficiary, the sole grantor of the trust. Then when the surviving spouse passes away, then it goes to whoever the new trustee is, runs it. The new beneficiary is the one who gets the assets and so forth. But it never goes through the court system. It's all private. You don't have to go publish it anywhere and do all those fun things. So a lot better. There's some stuff that does not go through, that if it's got a, something where it's owned directly, guardianships, wills can do and stuff, but some stuff that, wills just can't do. With the trust, you can do all these different things. um, and so, that's why you need to have them. And usually every trust has a will that says, if I forgot anything, this is where things go. The guardianship would be one thing that you'd want to have that in a will for sure. But um, and then there's two kinds. There's revocable and irrevocable. Now, lots of times people think, oh, I've got an irrevocable trust or something like that. And most of the time you do not. Irrevocable trust, the easiest way you can know if you have one is you have to fill out a tax return. It has its own unique tax ID number and so forth. So usually yours is just revocable, which means you can change it anytime you want to. So none of this is permanent. It just says, hey, I'm giving my house changing my house into there. I'm moving my, my brokerage account. I'm moving all these other assets into this trust. If you want to take it out, you can. Now, after you die, most trusts will always, or do always, become irrevocable. And so then that means that trust cannot be changed and your wishes will be followed through. So, that's why you want to do that. Now there are some irrevocable trusts you might want to do while you're alive. That'd be usually for charitable causes and other kind of, sometimes for nursing home costs, some other things that, there are some reasons why you want to do an irrevocable trust. But typically that's only after death. And so normally if you're talking about estate planning and such, typically you're talking about revocable trust. So how are some ways to avoid probate? Well, stuff like IRAs, 401ks, life insurance, annuities, anything that has a stated beneficiary section, that avoids probate. The problem is a lot of times people don't realize, like, their brokerage account doesn't have that. Even though it's, maybe say you've got an IRA and a 401k at Fidelity and you also have a brokerage account at Fidelity. So people always will tell me, oh yeah, no, I got beneficiaries on all of them. You can't have a beneficiary on a brokerage account. So if you're talking about securities, you can do TOD, transfer on death. If you're talking about bank type stuff, savings accounts, CDs, things like that, they always use payable on death. And so what that does is that moves those assets directly at your death to those people. So it is kind of a roundabout way to do it. If you don't have any real property, it might work. But usually you can't do that. It's pretty hard to do that lots of times on a house and stuff. You can sometimes, but it's a little bit less recommended, I guess, is probably the best way to do it. You can do joint rights of with joint tenants with rights of survivorship, but that's only for as long as one of you are around, right? So if you're a married couple and you're both on there, that's fine. When one of you dies, the other one still owns it. But at that person's death, again, there's no future owner unless you added a TOD or you moved it to a trust. Obviously, you can give away the assets or transfer the property to a trust. So, what are some guiding principles? How can you make sure that your retirement is successful for you and your estate both, right? Well, first of all, don't waste your money. That sounds pretty easy, right? But one of the things with IRAs, 401ks, 403bs, 457s, all that is taxed at your ordinary income tax bracket. So that can easily jump up your tax bracket rates. Those distributions can also raise your tax on Social Security. More distributions can actually raise your capital gains rate. There's a 0 and 10% capital gains rate, but those can easily get jumped over once you take out too much money from an IRA. And then, of course, you do have those required minimum distributions. Those were at 70 and a half. Now they're at 72. I don't know if you've heard this thing about the Secure Act 2.0 that's trying to go through Congress. They're thinking about slowly raising it up to 75. Really, most people need their money in retirement, so that's really going to help the wealthier people. But for people with pensions that are a lot of other income, or they've done a great job investing, that will save them a little bit of money. But that's just deferring that issue to down the road. Is more and more money that you have to pay later just could be a bigger and bigger tax bill. And this is the worst asset, hands down, worst asset to leave to your beneficiaries. So I have a client that he was living out here because he moved out here a long time ago. He lived actually in my neighborhood, but worked with a company we did a lot of talks at. And then now he's got younger kids, grandkids in the Rhode Island area, and so he moved back out there. But one of the things he always likes to joke with is, if I like my kids, how do I spend my assets? And if I decide I don't like my kids, how do I spend my assets? Well, the worst asset to leave to the next generation is any sort of retirement account because it's 100% taxable to them. Now, he was joking about this before the first Secure Act. Well, the new Secure Act made these even worse. So again, the Secure Act did a nice thing by moving it from 70 and a half to 72 when you must take that money out of that retirement plan. But the stretch IRAs have pretty much been eliminated. So the stretch IRA was this thing where you take that money, if you inherited it, you looked at your age and the age of maybe it was your parent who left that money to you. You looked up this formula on the IRS tables, and then that's how much money you had to take out, and you had to take out a little bit every year. Most people, 30, 40 years, they could stretch that money out. If you're a lot older, maybe it was 20. Now, 10 years. 10 years, and you got to blow through it all. And so if somebody passes away now in 2022, by 2032, that money has to now all be spent. Now, the crazy part is this law was passed in 2020, or took effect in 2020. It was actually proposed at the end of 2019. The IRS is still writing the rules. I mean, my gosh, can't we have these rules? So now they're starting to say, and we still are waiting for the final guidance on this, that now people have to take a required minimum distribution out of this money every year and then still have it spent by the end of 10 years. So it's very confusing. IRS can't even really tell you what the rules are. And for the people who inherited, and we've got clients who inherited money in 2020 and 2021, there was no required minimum distribution. You just had to have it spent by the end of the 10 years. Just last month, IRS now says, oh no, you have to start taking money out, but they didn't say about what formula and all this stuff. So it's very confusing right now. So that'll be a to be continued. So if you've inherited IRA money, be very careful about how you set up those things. So again, that 10-year distribution is pretty much for everybody. There are some exceptions. So the nice one is for spouses. So in other words, if it goes from, the husband passes away, the wife can roll it over their name. They don't have to blow it in 10 years. They can still spend it over their lifetime. So that makes sense. If you have somebody who's disabled, like an adult child who's disabled, they can stretch it out over years. There's some chronically ill. The really weird one is if you leave it to your siblings and they're within 10 years of your age, I guess mainly because they're about the same age as you, they say they can take it out over their lifetime also. Minors are a little bit odd. So not just because the kids are odd, but because of basically what happens is, like my son, right now, my youngest is 15. So if he inherited my money today, which would really suck because that means I'm dead. But if he did, he would have 3 years as a minor, and then the 10-year rule would kick in. So the 10-year rule still applies to the adult once the adult stops being a minor. So in other words, once they hit 18, it'll flip to that faster payout. So really, I guess at this point, he would get a 13-year payout. If somebody a lot younger, of course, could be a little bit longer. So, if those are some of the situations that you have, then definitely get some good advice before you take any action. So what are some things you can be doing? Well, right now, taxes are on sale. We all know taxes are going up. The Trump tax law goes away at the end of 2025. Biden's been threatening to change it, but still hasn't. So we'll see how that all plays out. But basically, with a Roth conversion, you pay the tax now. Now you don't go crazy. And I met somebody who he converted 600,000 in 1 year. He'd probably pay double or triple the tax if he had just done it over 2 or 3 years. So you don't want to go crazy and pay a huge tax. The easy way to think about that is When you do the Roth conversion, yeah, you have to pay the tax now. But let's say we run the numbers out and you look like you're going to be in the 24% bracket now, and you're pretty sure you're going to be in 24% bracket at age 72. I would still convert as much as up until you get to that 32% bracket. I wouldn't go to the next bracket, but I would convert, because if it's 24 and 24, it's the same tax, but what's the difference in between? Well, all that growth would now be on the tax-free side of the world. Now, it's a no-brainer if you're in the 12% bracket and you're going to be retired in 24% or 32%. Yeah, definitely convert. Now, if you're in the 37% bracket and you're going to probably retire in 24, then no, don't. So again, this depends on your situation, but if you do that Roth conversion, pay that tax, even if it's only for part of your money. That money now grows tax-free. There's no RMD. When it goes to your beneficiaries, it still goes to them tax-free, but they still have that 10-year rule. So after 10 years, they do have to withdraw all the money out of the account. But again, it's tax-free, so who really cares? And so a lot better way to leave your heirs, and even way better for you, if you can do some of those conversions in a sensible manner. You don't want to, like I said, jump up your tax bracket. There's also some charitable deduction options. Now, these have been around for a while, and Congress actually did not want to change those, but I think they actually made it a little bit more confusing. Um, so yes, they did move. They did move. So on item 2 there, I'll start with there. On item 2, they did move up the required minimum distributions up to age 72, but they left at 70 and a half this thing called a QCD, which is a qualified charitable deduction or distribution. And what this is it says, if I'm 70 and a half or older and I take $5,000 from my IRA and send it, not me, but have my custodian, whoever runs my IRA, just send that to that charity, that church, whatever it is. They would get that money tax-free because they're a charity. You would not have to pay tax on the money, and you would not have to get the write-off, but you wouldn't get the income. So if you have to, say, take out 5,000 out of your IRA, if you send it to a charity, they get all 5,000. If you took it out, you might get, say, 4,000, and then if you try to donate that, you may not have enough to write that off because you didn't get over and above your standard deduction. So what are the standard deductions for 2022? Well, right now, if you're married, it's 25.9 thousand as the standard deduction. Now, if you're 65 and older, it's 27.6. So that's what that other little number is. Single, 12.9. And again, if you're 65 and over, it's 14.3. Well, the biggest thing that the Trump tax law did is it limited that state and local tax deduction to 10,000. So that means your property tax, your state income tax, all that is only 10,000. For most married couples, especially if you have almost your mortgage paid off or paid down mostly, you may not have enough to overcome that. So you may be giving money to charities and not getting the deduction. So that's nice, it's friendly, but why don't you give it straight from your IRA if you're over 70 and a half, and then you just don't get that income. You don't get the write-off, but at least you don't have to pay the tax on the income. So a lot better way to donate to charities for sure. So also understanding the estate tax. So the estate tax, that is what lots of times people talk about, is they think there's a gift tax and there's a separate estate tax. It's all one tax and combined. Anybody can give $15,000 away to anybody without any issues at all. If you go over that, you're supposed to fill out a gift tax return. Right now, that number, sorry, actually, I didn't have the updated one for 2022 here, but this is 11.7. It's up a little bit higher, over 23 million for a couple. So for most people, the 11 million is fine. Now Biden's proposing cutting that in half, but still, again, for most people that should be okay. If you are going over that, then yeah, you do have to watch out, because that can start off at 37% and go up even higher in terms of your estate tax. So that's just the value of all your assets combined, including your IRAs and such. Will this change? It always changes. It was repealed for 1 year in 2010. It was back in 2000, it was like 600,000. went up to a million. 2017, it was at 5.4. And then when the Trump tax laws go away back in 2026, it'll go back to that 5.4, or it might get inflation adjusted. So again, this probably won't affect most people, but especially with the real estate values out here, it's starting to get a lot closer if they do cut that in half, or if it goes back to that 2017 level, or in 2026, which would be 5.4. So something to be stay tuned about. The only way to get stuff out of your estate is to basically gift it away. That's when you can use irrevocable trusts. You do lose a lot of step up in basis, so that's the other drawback. So in other words, if you gift away assets, you gift your cost basis. So say you paid $10 for some stock, and now it's worth $100. Well, if you pass away, your even your spouse or your heirs inherit that stock at $100 a share. But if you put that in a trust, or you gift that to somebody, in an irrevocable trust, sorry. So if you put this in an irrevocable trust to shelter it out of your estate, or if you gift it to, say, your kids, you gift them that cost basis. So now if they go turn around and sell that, they've got a $90 gain. Whereas if they inherited it, it would have been tax free. So again, sometimes when you try to avoid the estate tax, it messes up the income tax. So they're kind of two separate systems. If you're over that limit, let us know. We can kind of give you some pointers. Guiding principle number 2: don't run out of money. Duh, right? What's your risk score? You need protection from the next drop, which unfortunately pretty much already happened, right? I mean, it's only been a correction so far, has been a crash, but this year's been a little rough, and we've been telling the people for actually since last April, get out of bonds. Bonds are going to go down, and they had the worst quarter in 40 years. Why? The Fed stopped printing money. All that free money was buying bonds and going. Then everybody else who had bonds was going into the stock market. So yes, once the Fed stops printing money, we know the stock market is going to slow down. They're going to raise interest rates maybe 5 more times this year. We're already seeing mortgages hit 5%. They could be 6 or 7%. That's going to change a lot of things going forward. So definitely, you want to make sure you're protected from that drop. Look at your risk score, because if you lose a bunch of assets, then a lot of this estate planning may not be as valuable, because there may not be as much left, right? So you also need to have some sort of income plan that addresses long-term care. Now, long-term care, there's 3 options basically, right? I mean, you can self-insure it, you can have no assets and be basically poor to the government and qualify for what most states call Medicaid, and here in California we call it Medi-Cal. Or you can have some sort of insurance tool that may provide some benefits. So right now the national average is about $8,800 per month. I'd say most of my clients are 10 to 12,000 that they're spending on a monthly basis. What that does is, I mean, one thing, of course, is, that can cause tax issues to your estate if you're having to sell a bunch of stuff. Now, you do have a really large medical deduction typically. But I also have one client who's found a great caregiver, and we'll just say he's not officially paying her, and so he's not getting the write-off, and he's having to sell off a lot of assets. I mean, that's his personal choice to do it that way, but a lot of people do that to save some money. So there are some tax effects from that. I think the bigger thing to me is for married couples, what does this do to the healthy spouse? I mean, if you're taking care of, say, your husband, and you spend $500,000, and that's maybe year 3 or 4 of retirement, and then you've got to live another 25 years maybe on the leftover money. And if that money was cut by a third or half or something like that, it's going to really affect somebody's ability to have a nice retirement, right? So something you definitely want to be thinking about. Traditional long-term care insurance is awful. I just literally had a client get a letter, 298% increase over the next 3 years unless she gets rid of her lifetime income benefits. CalPERS, the state retirement system, they've been sued and going through this lawsuit for several years now over their long-term care policy, and now they're going to give everybody their money back. and just say, fine, here's your premiums back for the last however many years. You have no more insurance. Good luck. Well, that's awful. I mean, obviously these people are a lot older, right? So, you do want to have some protection. So that, there are some options out there. This is just a example of a 62-year-old female who's got some money in a fixed annuity, some money in IRAs. She doesn't really need the income. She's got other assets that she's getting the income off of, but she is worried, especially as a woman. You have to be very careful about long-term care because women outlive men, and they're usually the ones that are the caregivers. So if there's nobody there to caregive for you, guess what? You end up needing to have somebody help out and pay for these costs. So um, there's a couple different options. One is there's a great annuity company that we use, annuity product. That one can give you just answering just a few questions. If you answer all these questions, and I think the stats about 83 or something percent of people can answer them with no problem. They'll give you triple your money for long-term care. If you can't answer all of them, you might get double. And there's about 4 or 5% of people who can't get this. But for most people, they can get it. There's no medical requirement or anything like that. But basically, what they do is they take your 250,000, they put it into an account. Right now, it's earning I think 2.75 or 3% or something like that. And but that 250 would instantly day one be worth 750 for long-term care. And so that's a benefit that they would divide that out over 72 months and pay that out to you. The crazy part is this could be an annuity that you had from a long time ago that has a lot of tax, built up tax liability into it. You can roll it over tax free into this account. And if you need long term care, that money comes out tax free. Great deal. Great way to avoid taxes. And then it also earns some money. Now they takes a little bit of fee, but even with the fee included, it'd probably be worth 270, 280 in 10 years or something. It grows a little bit, but you can also cancel it anytime you want and get your money back, no surrender fee. So great tool. They also have a joint option. So if it's a married couple, it's great, I think, because you can just buy one. You don't know who's going to need more care, so you have one big old pot of money that either one can use. Again, it's a great, easy way to do it without really needing much medical stuff or just a few simple questions. No tests, can't fail anything. Um, Another option is take some of those life insurance, take some of those IRA dollars and fund a life insurance that has some long-term care benefits. Now, why would you want to do this? Well, again, that IRA money you could convert to Roth, or you could just, take the money out, give to your kids or something like that. But if you take that money out, buy life insurance. Now, assuming you're healthy enough and you do have to qualify. Now there's a tax-free death benefit. So let's say you take some money out and you get a $300,000 life insurance death benefit. Well, now those little bit of dollars that you're taking out is going to be worth 300,000 tax-free. Doesn't have to be spent over 10 years. It could be used however your heirs want to use it. Also, most companies allow you to take out 24 to 25% of that death benefit as a long-term care benefit. So in other words, off of 300 grand, 25%, easy math is cut it in half, right? So, so you'd have about 75,000 a year of long-term care benefits if you need them. If you don't, we all end up the same way, right? Whenever you pass away, that money will go tax-free to your heirs. Now you're taking that taxable asset from the IRA, paying a little bit of tax, but putting it in something that's going to be permanently tax-free. And then you can also have these benefits. So it's a good way to also shelter some of those things. If you have a larger estate, you can even do that in a life insurance trust and even get it out of your estate. So lots of great ways to do that. So there's also some annuities that do even more long-term care benefits and such. But I'm a big fan of just paying for the stuff once or twice or just a few installments and then being done with it, where the insurance company can't come back and say, oh yeah, we're jacking up your rates. I helped a client back in the late 90s with a long-term care policy. She's in her late 70s now, living out in Idaho, and she had a 100% rate increase, had a 37% rate increase. All these awful things. Now we've had to take off inflation protection off of that because it's the only way to keep the premiums from, being affordable. So again, there are solutions like the annuity, the life insurance. great ways to go, to really protect yourself. Again, if that's something you want to, take advantage of, you can book that time, schedule a time, and, just let us know about that. Um, and then don't lose your money. Well, of course, we already kind of talked about this a little bit, but here's back in 2008 to 2013. That's how big that that the Great Recession there was, right? And how many years that took everybody to come back? 5 years. Well, of course, if you needed care down there at that low point where that red arrow is, you might have to sell some stocks at bad times, and those shares don't come back once you sell them. Now right now it's been crazy, right? There's the dip in the middle there of the screen, 08 to 20, to 2009 until it finally came back up in 2013. Then the Fed went crazy and just printed trillions and trillions, especially after the COVID crash. And now they're not printing money. We're going to see what happens. In 2018 was a few times that they took money back out of the circulation after they printed it, and it really drove down the stock market. We had a 19% drop at the end of 2018, mostly due to the Fed pulling those dollars back out, and they're threatening to do that the third quarter of this year, start pulling out all this unprecedented money that they dumped into the economy. So that's another thing that you have to really, really be watching for, because again, if you're thinking, oh, I've got plenty of assets, I can self-insure. What if those things go away, right? So that's where like the annuity, dump in 100 grand, get 300 grand, that can't go away, doesn't go down. It's there for the rest of your life. So, you've got some prepaid money, and worst case, a little bit more than 100 grand goes to your beneficiaries. So you don't really ever lose it. It's just, you may not be earning as much as the money in the market, but you're also not losing it. And if you need that long-term care, then it's going to be, again, probably triple the money that you put in there. So, you really need to have a comprehensive estate and income plan, both. Um, One of the things that we're talking about always here with anytime we're talking about an income plan is, where are those paychecks in retirement going to come from? How are they going to get there? How long will they last? Will they grow over time? What happens if you do have a medical emergency and you have to spend down a bunch of assets? What happens after one person passes away? You lose the one Social Security check, so that's going to go away. If you have pension money, does the other spouse still get the full amount, or is there a reduction? And then also, what happens to your tax bracket? Well, the crazy thing is, I had a client that we do their taxes, and he after he lost his spouse, they were both retired teachers, and they both did 100% survivorship options on their pensions. So after she died, he still got the same pension. He still got his pension, but he made $20,000 less income because they lost some of the Social Security, some of the other stuff. But guess what? He actually paid $20 more in tax. So he had less income and the same exact taxable amount that he had to pay. And that's because he went from married, filing jointly, to single. So again, those are things that you have to always be counting in your income plan, is also what happens after somebody passes away. A lot of us don't have life insurance when we're older because we had group insurance, so there may be no insurance coverage. So there's no other dollars coming in. And so that's one of those things that you have to really do, not only plan for your retirement for you personally, but if you're married, you got to plan for your joint retirement. And if one of you are gone, make sure the other spouse is still there taken care of with that income plan. So, there's 5 areas everybody should be focused on. Obviously, like I said, income's number one. You can't retire without income, right? Number 2 is, look at how your investments are optimized. Do you have some money that's guaranteed, some foundational money, stuff that can't go away? So in those bad times, just for income, you can take money out, or also for if there's medical emergency, other things. Is there some money that's guaranteed? Do you also have some steady income money, the money that keeps cash flowing in every single month or every single quarter, that doesn't have a lot of volatility? A lot of our steady income portfolios haven't even dropped negative this year, and they're still paying out those great dividends. So that's one nice thing about that, is if you need that income, that revenue coming in, that can really help. And then you're talking about the market money, but 401ks are only market money. You want to navigate that healthcare issue, not only just Medicare, what supplement and all that stuff, but Medicare does not cover long-term care. So Medicare, the only thing that they'll cover is if you're in the hospital with some sort of ailment, and then they say you're not good enough to go home, but you need to get out of the hospital because it's too expensive. They will send you often to a long-term care facility, and then as long as you're improving, they'll keep covering you. But once you stop improving, they will actually no longer pay for your care. The most they would ever pay for is 100 days, but that's pretty rare. 100 days. That's less than, it's 3 months, right? A little over 3 months. That's it. So if you're needing care for a year, there's no insurance for that other than long-term care type provision. So Medicare is not going to cover that part. So again, that's why you have to decide: are you going to self-insure? Are you going to try to go broke and spend all your money and be, if you're single, you need to have less than $2,000 of assets. You have to give all your income except for $35 a month to be able to get covered. So again, if you don't want to have that happen, you want to have some sort of plan in mind for how to pay for all that. Obviously, you want to minimize the taxes, not just what people are doing this week for, right around this time of the year for last year. We want to talk about what are we doing going forward, how we lower the taxes, not just this year, over the rest of your life. And then again, lastly, the part we were talking about really is the legacy stuff, right? Making sure that you have that money set up and in the right spot. Now, one thing about the legacy is we just started this, and I'll throw this up here for a little bit here. We actually have a software that you can try out for 10 days. It's set up by some great attorneys, and we can give you a pretty good discount from what the published price is. But if you want to just set up your own trust or your own will, you can do that online if you want to do that. It's a great tool. We were finding, because a lot of people just don't want to meet with attorneys. They want to do it on their own, but they want to make sure it's done right. This company will actually even do the transferring the title in your house and so forth. So that's a great option there. So if you click on that Get Access Now button, it'll let you sign up for that. But really, like I said, you want to have that income plan. I mean, my goal is, my mom was always worried about everything financial, worried about this, worried about that, and she'd always ask me, okay, how am I going to be retired? How are we going to do all these things? And so my process is named after her concerns of worry less wealth. I want you to worry less about your money and more about having fun, enjoying life. So again, having that income plan, that investment optimization, the tax minimization, healthcare, legacy, those are the 5 areas you gotta have taken care of, or else the government's going to take care of it for you, and they don't do quite as good a job. So that's really the areas that we want to focus on and be able to help you with. Um, and so again, there's that link for if you want to look at that software. Um, and then also, well, here, I'm going to put up here in a second, if you did want to set up a time to talk, just to tell you about our process again, there's no cost, there's no obligation. What we do is set up a 15 to 30-minute phone call usually, or you can do it in person, but just find out what's your situation and what your concerns are. From there, then we would actually, we've just, since COVID started, we've been waiving our fee for doing the planning. So we'll actually tell you, we'll go through all these 5 areas and say, okay, here's what's good, here's what's working. It's kind of like if you're trying to drive to LA, and we'll tell you, hey, you're headed to the Sierras, you're going the wrong way. We'll tell you what's good and bad on that course, on that trip, and what areas you might want to avoid, and what things you might need to fix. So we can go through all those issues on your plan, help you figure that out. And then at the end of that second meeting is actually then when you decide, hey, do you want to have us help you with stuff? Or you can go off and do it on your own. But again, there's no cost, there's no obligation. So it is a really great way to really get some feedback about your plan and where you're at right now. So again, if that's something you want to do, all you have to do is click on that schedule a call. It has our times for the next several weeks. You can book it right there. It is tax time. We are pretty crazy busy, but we did leave some spots open to help people, to really kind of get them this information. So let's see. I went through a lot really fast. So again, if that's if there's any questions out there, let us know. We have the chat function up there right now. Actually, don't see anything. So, yeah, if if you did want to also talk to some attorneys or other stuff, I mean, you don't have to use the software. We've got some great attorneys we could refer you to. Also, if you have more complicated situation, but I think the software is pretty good for most people that have a pretty common situation and nothing too funky or too odd. There is some stuff like if you have somebody who's got drug or alcohol issues, if you've got somebody who has special needs, there are some other things that you might want to definitely look at. The software does take care of that, but also we can refer to somebody who's skilled in that area too. So let's see. Well, with that, if there's no other questions. Does not look like it. So, well, I appreciate your time. I'm glad this was a little faster than advertised. But again, let us know if you have any questions, if we can help you out at all. If you want a little bit more information on that software. And by the way, if you do look at the free trial for the software, then definitely email us and we can set up we'll set up a discount code for you because the 14.95 price is too much. So yeah, we can get you a discount on that. But go ahead, check it out, look at it, and let us know. I put that back up on there. But other than that, thanks. Have a great evening. And if you haven't done your taxes, go do them now. And talk to you soon.